Welcome to Module 14 of our financial modeling series. I am your course administrator, delivering this module on behalf of SMB experts. In this session, we move from traditional corporate ratios into the world of small and medium-sized enterprises and microfinance institutions. Our focus is on practical modeling techniques that help you evaluate cash flows, portfolio quality, and social impact. Let's see how financial models become a GPS for SME and microfinance decision-making. In this module, we will build a clear framework for SME and microfinance models. We will examine how these models differ from large corporate models, why cash flow and portfolio risk matter more than accounting profits, and how to link financial projections with both financial and social objectives. When we model SMEs, we cannot simply copy and paste a large corporate template. SMEs are more cash flow constrained, have thinner management teams, and often lack long track records. Corporate models tend to emphasize earnings and valuation, while SME models must prioritize survival, liquidity, and funding access. This change in focus affects every assumption we build into the model. On the SME side, we emphasize cash flow focus. Can the business pay suppliers, staff, and lenders on time? On the corporate side, we emphasize earnings focus. Are margins, EPS, and valuation metrics improving? A strong SME model tracks monthly cash flows, seasonality, and working capital swings, while still connecting back to profit and loss and long-term value creation. For SMEs, lenders increasingly rely on cash flow lending. That means your model must project operating inflows and outflows with enough detail to identify tight months. We pay attention to revenue seasonality, payment terms, inventory cycles, and tax schedules. A good SME model highlights when the business will need additional working capital or overdraft lines to stay liquid. Here you can see a simple SME cash flow forecast. Operating inflows are broken down by product or segment, while operating outflows group major expense categories. We project these on a monthly basis and link them to assumptions such as growth rates, days sales outstanding, and cost inflation. This approach allows us to test whether the SME can service its debt throughout the year, not just at year-end. Microfinance institutions add an extra dimension to our work. They manage large portfolios of very small loans, aiming for both financial sustainability and social impact. Their primary revenue driver is the loan portfolio, so our models must capture portfolio growth, repayment behavior, and credit risk at a granular level, often by product or client segment. This type of portfolio dashboard shows exactly what matters to an MFI: portfolio at risk, disbursement rates, and repayment rates across time. In our models, we project new disbursements, scheduled repayments, expected defaults, and write-offs. By adjusting these drivers, we can test how sensitive the institution is to deterioration in portfolio quality or sudden drops in disbursement volumes. Unlike a pure commercial lender, an MFI operates with a double bottom line. We evaluate not just financial returns, but also social outcomes, such as outreach to underserved clients or impact on income stability. A robust MFI model allows management and investors to see how strategic choices affect both return on equity and social performance indicators. In practice, we may track social metrics alongside financial KPIs. For example, we might compare portfolio growth with changes in average loan size or the percentage of first-time borrowers. When we design the model, we ensure the structure can report on both sets of indicators, so management does not have to choose between mission and margin. They can monitor both in one integrated view. From a tooling perspective, most SME and microfinance models still run on Excel or similar spreadsheets. However, specialized tools like Microfinance and other portfolio modeling systems are widely used in microfinance. As a modeler, your job is to understand the logic behind these tools, how assumptions link to disbursements, repayments, defaults, and funding costs, so you can audit or customize them when needed. This screenshot illustrates the level of detail a microfinance planning model can reach. We see projections by branch, by product, or by region, with separate schedules for loan portfolio, funding, and operating expenses. When building or reviewing such a model, we always check that key ratios, like portfolio at risk, cost of funds, and operating expense ratios, are computed consistently across all periods. Scenario and sensitivity analysis are non-negotiable for both SMEs and MFIs. We rarely trust a single base case. Instead, we prepare best case, base case, and worst case scenarios to understand the range of possible outcomes. This is especially important where clients are vulnerable to shocks like crop failures, currency moves, or political instability. Here you see a simple scenario analysis for SME revenue growth. In our models, we link scenarios to drivers, sales volumes, pricing, default rates, and funding costs. By toggling scenario flags, the entire model recalculates, and we can quickly see the impact on cash flow coverage, covenant compliance, and capital adequacy. This helps lenders and management prepare appropriate contingency plans. A major challenge in SME and microfinance lending is the lack of traditional collateral and credit histories. Increasingly, institutions are integrating credit scoring models that use alternative data, such as mobile phone usage, transaction behavior, and informal repayment histories. As a modeler, you must understand how these scores feed into approval rates, pricing, and portfolio quality. This illustration summarizes the idea. Alternative data points, mobile usage patterns, and repayment history from previous informal or digital loans can all be converted into risk scores. Our financial model must then translate those scores into default rate assumptions, loss estimates, and pricing decisions, ensuring the business remains sustainable while expanding access to credit. To close the loop, we must be explicit about risks. Microfinance institutions face over-indebtedness risk among clients, currency risk when borrowing in hard currency, operational risks in decentralized branches, and political or regulatory risks. Our models must make these risks visible through ratios, stress tests, and narrative commentary in the assumption sheet. This summary view of key risks is a good starting point for your own models. For each risk, you should decide which assumption to stress. For example, to simulate over-indebtedness, you might increase default rates and reduce collection efficiency. To test currency risk, you might shock funding costs and revalue foreign currency liabilities. Good modeling makes these stress tests quick and transparent. Let's summarize Module 14. You have seen how SME models emphasize cash flow and working capital, while microfinance models center on loan portfolios and double bottom line objectives. You have also seen how tools like Microfin, scenario analysis, and credit scoring help us capture risk and uncertainty in a structured way. Together, these techniques equip you to build models that lenders and investors can trust. The key takeaways for you are clear. First, focus on cash flow lending for SMEs. Second, monitor portfolio quality relentlessly for MFIs. Third, integrate social impact alongside financial returns. And finally, build robust scenario planning into every model you design. With these 4 pillars in place, your SME and microfinance models will be both technically strong and practically useful. Thank you for following this Module 14 training on behalf of SMB experts. I hope you now feel more confident modeling SMEs and microfinance institutions, balancing financial sustainability with social impact. I invite you back for our next module in this series. Please remember to subscribe to the SMB Experts YouTube channel for more professional financial modeling content. Goodbye for now, and I will see you in the next session.